Gigi,
Good morning.
you've come back. Good. Hi, Joshua. There's Joshua. He's connecting to audio. Hi, Joshua.
Hey, good morning.
Good.
Sorry,
Good.
my
What's
hair's
that?
all messy right now.
Hey. I wish I had hair to worry about like that, huh?
Yeah.
You know, I've been a cue ball since about 25 years old. One of the great disappointments in my life, you know? Anyhow,
Now you saved on jail, so I think it's a benefit. Saving.
well, I've learned to cope with this. Hey, I guess it's just
Yeah.
going to be the two of you, maybe one or two more. I believe we're only going into chapter 2, how we had our first class this past Wednesday. So looking at the schedule, I think that's correct. So with that in mind, I'm going to talk about chapter 2. And this is accounting 110, right? Okay.
I think so. I mean,
Yeah, no, it's
yeah.
110. I have another couple of classes now. I just, sometimes I mix them up a little bit, especially when you don't meet the people for the most part, right?
Yeah. Oh wait, isn't this 230?
230, no, it's 230 is at I thought 110 was
Financial. This
Oh,
is
now you-
financial accounting.
what's it called?
Financial accounting?
Okay, hold on 1 second then.
Yeah.
110. Yes, you are correct.
Yeah.
Thank you for stopping me.
Yeah, no worries. Yeah, we're in chapter 4, I believe. I was like, wait, I think I went ahead.
Yeah.
Nah.
Okay, forgive me, everybody.
Yeah, no.
Okay, let me get into the right class. See, what's got me all fouled up is the 110 began this week. Okay, so we're here we go. We're 82078. And I guess chapter 4, you guys have a test coming up this weekend, is that correct?
Yeah,
On chapters 1 through 4, right?
correct.
Okay, so let's get into one. Let's get into chapter 4 finally. Okay, we're getting there.
It's because right now I'm taking another financing class, and it's 100. So I was like, wait, 110. It sounds, I think so, but let me
Yeah,
double check. Yeah.
Now 100, like you said, that's not a class I can help you with, to be honest with you.
Yeah.
I can do a little bit. Okay. Okay, now I believe we are where we want to be, huh? Hi, John. How you doing? And Raleigh has just joined us. Hey, hi, Raleigh. How you doing?
Good
Pretty good,
morning.
sir. How are you?
Doing well. How
Did we help you out a little bit last night, Raleigh?
Yeah, I did. Thank you for your help. My computer just died in the middle of it, so I didn't say thank you.
Okay. Okay. All right, John, we'll get going here. Chapter 4. Let me share the
Oh, is
screen.
this only chapter 4? Is it like a midterm review?
Yeah, we haven't gone into chapter 4 yet, have we? I don't believe so.
Oh, or by the way, if this is recorded, will it be uploaded like today?
What, the video, this video?
Yes, sir.
This video will be uploaded about a half hour if you go to my Bob Smagula YouTube channel.
Okay. All right.
And you'll find it there. You know, you'll be able to recognize it by the title, and they're in chronological order. It takes Cornelia a couple hours to put them up on the what do you call it? Canvas schedule.
Canvas,
So it's in 2 different places, Raleigh. Okay.
Okay. Can I watch it later? I'm moving out of my apartment right now. I just wanted to stop by.
Of course.
Okay. All right. Thank you so much for your help, and I'll talk to you soon.
Hey, we'll see you later.
All right. Bye-bye.
It's not letting me share. Hold on. Okay. Come on, share screen. Yeah, it's not what we want. Can you see these PowerPoints now? Can somebody tell me if they can or can't?
Yeah, I see
They are-
chapter 4.
Okay, it says accrual accounting concepts, huh? Okay.
Yeah.
All right, that was a bit left. Boy, it's like tough to get going here, but it's only 9:05. Okay, financial accounting. What do we have in store here? We want to pull up the PowerPoint version of this. Okay. Give me a second here, guys. Please hang in there. We'll get going.
No rush.
Okay, now we have it. Here we go. Financial accounting. We're going to talk about adjusting journal entries. Now, did we already go over adjusting journal entries? If we did, it's not a bad idea to keep doing it. Okay.
I thought we went over chapter 4 on Wednesday.
Pardon me?
I thought we had gone over through chapter 4 on Wednesday.
Okay, we went over chapter 4. Okay, so Joshua, what do you think? Have a review session now? Would that be helpful?
Yeah, I mean, this is the first lecture I actually jumped into, and I haven't even seen the previous ones. So yeah, my bad. I just been pretty busy, and I just decided finally to jump on the lectures today.
Yeah, you'll be able to catch up. Okay, so let's do that. And that could be a fun way to kill a little bit of time here, okay? So let's do this. Let me pull up the PowerPoint for chapter 1. Let me get out of this. PowerPoint. Well. Normally, we don't have this kind of problem getting started, believe me. Okay, here we go. Get rid of that. Stop share for a second. Let me go into Canvas and dig up chapter 1. You guys, the timing was pretty good on this then, huh?
As in, yeah. I
Okay,
don't know.
okay. Let me make sure I get into the right class. You wouldn't think 3 classes would confuse me so much, huh? Okay, double checking 82078, right? Okay. All right. Yeah, there'll be some real basic questions to get you going here. 82078, chapter 1. While I'm pulling this up, one thing I would do is make sure you keep up on the summaries and everything. The summaries are a significant part of your grade, and that's like stealing money. You know, we ask you to write 3 or 4 pages for each chapter. Come on. Whammo. Okay, I think I got it. Okay, do you now see the screen? It says intro to financial statements.
Yes.
Okay, here we go. What do we want to talk about here? The forms of business, okay? On your test, they're going to have a couple simple questions, kind of just get you going. They're going to want you to tell them the difference between a sole proprietorship versus a partnership or a corporation. And the key thing to remember is in a sole proprietorship, which is a business pretty much owned by one person, and a partnership, which is owned by 2 or more people working together in some sort of proportionate capacity. The key thing with those two is you have the disadvantage of personal liability. What I'm saying, guys, is if you open up a sole proprietorship or a partnership with $10,000, and at the end of the first year, you manage to lose $1 million somehow, you are personally responsible for that $1 million, okay? So there's no corporate shield there. Corporation That's not the case. There's no personal liability unless there's fraud or something, which is a different story. Corporations owned by the public buying stock. Now, you're going to be doing a lot of financial statements in this class, a lot of analyses of the receivables and inventory and fixed assets and all kinds of things in the next 4 weeks. Who uses this information? They like to talk about this on the test. We have the management of the company. The top management wants to know if the business is profitable. And if it is, are they in a position to expand? Do they have any opportunities since they're doing so well? The marketing people want to know your salespeople because their commissions might be based on some metrics where if the company makes a certain amount of money, the marketing people, the salesmen get a bonus. The accounting people need to know, the people in finance and human resources. So internal users need this financial information. External users. Now here's the people who really need this stuff, okay? These people will not have anything to do with you if you don't have audited financial statements. Investors, possible investors in your company. Creditors, creditor means a lender. A lender and a creditor are synonymous. Lenders, and they're talking about other possible investors here, I guess. But no one is going to loan you money. No one is going to invest in your business on any large scale unless you have audited, proper financial statements. So that's who uses these things. Try to borrow money without good financials. You forget about it. You see these two words here, Sarbanes-Oxley Act, SOX. I would write that down on a sheet of paper, just have it in front of you for a while till you memorize it. Sarbanes-Oxley, not going to go into detail, but what this act did was force ethical behavior on company management. It used to be that a company could turn out bad financial statements, whether they were wrong deliberately or not, and upper management could skate. Upper management could point to Gigi. Gigi's the accounting person. She put these together. And believe it or not, that's kind of how it used to be. With Sarbanes-Oxley, management now has to sign off on these financial statements. They have to admit that they read them and understand them, okay? And if there's any real problem with them, they'll be the first ones to go to jail, okay? Ethics. And I could talk forever, but I'm not going to do it now, on these various disastrous bankruptcies that were the result of fraud. Enron, WorldCom, Health.Care, I could think of a number of others. Real quick on the ethics. Ethics, you know, the way to do things properly. We want to do it in such a way that we don't hurt anybody and that what we do is absolutely true. If it would happen to hurt somebody inevitably. So solving an ethical dilemma, recognize the dilemma, identify what's going on. Here's what we're talking about with ethics. I felt the pressure, would you? That's what some people at this law firm said when they helped to overstate revenues and use accounting tricks to hide losses and cover up cash shortages. I was instructed by the CFO to create invoices, knowing they're not going to be sent out. In other words, they recorded, in essence, journal entries that debited accounts receivable and credited sales. So they look great. They were pumping their sales up falsely until the roof fell in on them. That's an ethical thing that's obviously wrong, but don't succumb to the peer pressure. Here's another good one. I intentionally gave the auditors incorrect information. That's a real no-no, obviously. So ethics, there might be a question or something about that. In choosing, identify each of the following. Okay, this is a good screen to study. You might mark this screen. What's good about a corporation? Easy to raise funds. Sole proprietorship partnership are easy to set up. Corporation, they're protected with the corporate shield on failure. Tax advantages go to sole proprietorships and partnerships, but corporations easy to transfer ownership. Just call your stockbroker or hit a button on your computer and you can sell your shares. Not worried about that. Okay. Here, 3 words. Okay, we're not on the test. We're not going to go into great detail. When you get to chapter 12, I think, toward the end of the book, we have a whole chapter on this. 3 types of business activity. financing, investing, operating. Financing, investing, operating. What is financing? Financing is borrowing, basically, raising money other than from selling your product. Financing, you borrowed money, which has to be paid back. It's called a liability. And the party to whom you owe the amounts are creditors, notes payable. Financing is borrowing money or raising money with a stock issue. And they're talking about a stock issue here. Company says, we're going to sell 1 million shares of stock to the public, $1 par. Hopefully we'll get maybe $30 a share for it, or whatever their hope is. Investing is just what the word says. It's you going out and buying big ticket items like computer system, delivery trucks, furniture. These are big ticket assets that are going to be around for a long time. And thus those are called investments. And of course, if you buy stock or a bond in another company, that's also an investing. Operating activities, this is the key one. This is the key, because this is the activity that's generated from normally what the company does as a business, okay? Here we generate revenues from the sale of our product, and we record the various expenses. We go through inventory, we go through accounts receivable. We take our revenues and subtract expenses, liabilities, and guess what? You have net income when revenues exceed expenses. Who knew, huh? Types of different activity right here. Let me look at this quickly. I don't think this cuts much ice. I'm not gonna worry about that. Okay, the 4 financial statements, 4. We're gonna really work on just 3 until we get to chapter 12 or whatever it is. 4 financial statements: income statement, retained earnings statement, balance sheet, cash flows, Take a look at a very simple income statement. What did we just say the income statement is? We said it was sales minus expenses, right? Look at your sales here. Look at your revenues. Revenues and sales can be interchangeable. Your sales were $10,600, and this company incurred salaries and wages, rent expenses that totaled $7,740. As a result, your net income is $2,860. So that's a real poor man's quick look at a very simple income statement. The income statement is simply revenues minus expenses. There are no liabilities. There are no assets or capital items on an income statement. It's just revenues and expenses. And the income statement covers a period of time. Now look at the retained earnings statement. This is the one where the students get a little confused. So let me make life easy for you, okay? You have to do these financial statements in order. It's impossible to do them out of order. You have to do the income statement first, retained earnings second, and balance sheet third. So the reason we have to do the income statement first is we're going to pluck that number on the bottom. You see that net income number, 2860? We're now going to go to the statement of retained earnings. And since this was a new company, they had 0 to begin with. They add the net income and they get 2860, and they're going to subtract any dividends. So the acronym for that, if you like mnemonics or acronyms, BIDE. You know the expression, you bide your time, BIDE, beginning plus income minus dividends equals ending. Retained earnings is part of stockholders' equity. It is the component in stockholders' equity where all of the net incomes of the company are accumulated month by month. So if this company had 2860 here and they had another 1,000 next month, retained earnings would go up to 3360. And it would just go up and up or down if they lost money. The only other thing that affects retained earnings for you right now are dividends, if they choose to give out a dividend, okay? And here's a little bit of a schematic on the relationship of the statements. This is what we just did. We did the income statement first because the net income is needed to get the ending retained earnings. We know the net income is going to be added to whatever the retained earnings were at the end of the month. 0 plus 2860 minus those dividends. Bide your time. And here is the balance sheet. Let's take a peek at this. The balance sheet. You know the accounting equation now, right? Assets equal liabilities plus equity. That's pretty much what the balance sheet is. It presents the total assets, and they show that the total assets equal what? Liabilities plus equity, which total the same thing, 21,910. Balance sheet. It's the presentation of the accounting equation. No revenues and expenses on that, okay? The balance sheet. See where it says reports assets and claims at a specific time. What this means, guys, is you notice that the heading here says October 31st. You have to say it that way on a balance sheet. You have to say something like as of December 31st or at December 31st or December 31st, just like you see there. The reason for that is the balance sheet is a snapshot in time. It's simply a photograph, if you will, of all of your balances in your general ledger, okay? For these items. Balance sheet. They go up, they go down, they're not accumulative. They're at the end of the month. At the end of the month, this company had $15,200. The income statement and retained earnings is sort of the opposite, where you say for the month ended, and that's important. You got to say for the month of or something like that, because this is a video. Balance sheet is a snapshot, a picture. This is a video. Your sales are going up, up, up every day. Your expenses are going up, up, up every day. So it accumulates, and thus you're covering the whole month. Statement of cash flows, believe me, we're not going to get into this in any detail on the test, but just remember what's operating, what's investing, what's financing, okay? Statement of cash flows, statement of cash flows. I don't think I need to get too much into this. Okay, let me just talk in terms of, you ever hear the expression teaching to the test? That's what I'm kind of trying to do a little bit here to help you guys out, okay? The statement of cash flows tells us where we got our cash and where we spent our cash, okay? And at the end of the month, we want to look at what's in the bank now. We want to look what's in the bank now, June 30th, and compare it to what was in the bank on June 1st. So in this case here, they had a beginning balance of 0 because it was a new company, and the ending is 15,200. So the question becomes, how did they raise that 15,200? Well, about 1/3 of it came from operating, but that was offset. That was just about offset by investing. They bought a bunch of equipment. The real big ticket item was they raised cash. They issued stock and they borrowed money, okay? So operating, investing, financing. At the end of the month, you want to see a big number in operating. That's the important one. That's the controllable one. The other two are not really controllable. Net income, revenues exceed expenses, huh? Which of the following statements is a snapshot? Is prepared as a specific point in time? The balance sheet. That's important. Okay, here they're asking us to put together a financial statement. Let's just start it a little. I'll get you started here. Remember what goes on the income statement, only revenues and expenses. So let's quickly go down the row here. Accounts receivable, payables, that's not expense. You know, you can tell it's an expense when it says expense. So we know we have rent expense, notes payable, common stock, retained earnings. None of those have anything to do with revenues or expenses. So far, we have rent expense, insurance expense. We got sales here, 17, supplies expense. So I'm looking at, what are we talking about here? I'm looking at rent, insurance, supplies, and maybe one other one I might miss. So let's take a look at our income statement. There it is, 17,000 minus those 3 expenses. So gives us net income. Now they want us to do, I guess it's using the same number. They want us to do a retained earnings statement. Uh-oh, and notice there's a question mark here. Well, we know we did we know we had a profit of $6,800. So let's keep that number in mind because we know that goes on the retained earnings statement. So what goes on the retained earnings statement? The beginning retained earnings plus your income minus dividends equals your ending retained earnings, okay? So that's what we're talking about. So we don't care anything about anything on here really, except retained earnings. And we know the beginning balance was zero. We know that. They told us it's a new company. And we know our net income was $6,800, right? All we want to look for now are dividends. BIDE, bide your time, dividends. Voila. Beginning retained earnings, zero. Add your net income, 6,800, minus dividends equals 6,200. Retained earnings statement. Now they may ask us for a balance sheet here. Balance sheet. You see where it's got a question mark for retained earnings? We already figured out the retained earnings. We now know it's 6,200. So what goes on the balance sheet? Assets and liabilities and equity. So accounts receivable, payable, they would go. Any payable here? Common stock, retained earnings, equipment, supplies, cash. So I'm looking at a balance sheet where it would be cash, accounts receivable, supplies, maybe something like that. Cash, accounts receivable, supplies, and the equipment. Here are your liabilities. And here we're bringing over the 6,200 into retained earnings. Stockholders' equity. Assets equal liabilities plus equity. Equity at this part of your course consists of common stock, which we issued to the public, plus whatever monies we made in profit, retained earnings. The annual report that is provided by a company must include a few things. It has to have the statements, and I'm not going to go too terribly far with this. Just know that there are notes to the financial statements. You'll see a line you'll see a balance sheet, and everything has a footnote next to it. You'll see accounts receivable, footnote number 1. And you go to the note, and it might be 10 pages talking about accounts receivable, how they sell their product, how they collect their cash, how they give out credit to their customers, what the future looks like. And the auditor's report, the CPA's put together. That's a key thing. Take a look at this screen here. I would glance at this doing your studying. What we're looking for from the auditors is what's called an unqualified opinion. Unqualified. It means that everything was okay. Nothing had to be qualified. And I mean that negatively. A qualified opinion would be these financial statements are okay, except we found out that the boss stole $1 million, that type of thing. So you're looking for an unqualified opinion from the auditors. We get to international, we know that our chapter has ended because we don't cover international. If an international question comes through on the test, tough luck, okay? No, I'm only kidding. I go through each test and pull those guys out. Anybody have any questions on chapter 1? You want to go to chapter 2, Gigi? Well, that was chapter 2.
No questions here.
Okay, chapter 2. We finished with chapter 2. Get rid of that. Okay, I'm going to need a moment to re-rack here. Stop share. Okay, how you doing, Hope?
I'm doing all right.
You following what we're doing today?
Yep.
Okay. Hello? Get lost. No, that was my cell phone, actually. The alarm. Come on, Bob. Okay, come on. We're looking for chapter 3 in 82078. Chapter 3. Chapter 3 says you love it all in your heart. Chapter 3. Yeah, here's where we got into some transactions, huh? Chapter 3, come on. Okay. Chapter 3 is racked up. Do you see chapter 3? Can somebody give me a verbal indication you can see it?
Yes, we can see it.
Okay. Once in a while, I look like a moron here. I sit here for an hour lecturing and don't have the PowerPoints up. Okay. Chapter 3. Here, we're going to look at business transactions, how to use the journal. Yeah. Accounting events, accounting transaction or events that require something in your financial statements. Not all activities require transactions, like an announcement, we hired a new president or something like that. The key thing is anything that impacts anything in the dollars requires a dual effect. You're going to learn you have to have one debit and one credit for a transaction. You can have more than one debit and 100 credits, or one credit and 1,000 debits. You get the idea. As long as the total debits equal the total credits. And here's a quick example. We purchased a computer. Well, that's obviously a financial transaction. We have to increase our assets here, and we're going to probably credit accounts payable, huh? We paid the rent at the end of the month. That's certainly transaction. But here, we discussed guided trip option with potential customer. We brought some of our customers into a meeting and we're trying to get their business. Well, nothing happened. That's just a non-transactional event, okay? Basic accounting equation, assets equals liabilities plus equity, must always be in balance. Each transaction, dual effect. You're going to increase or decrease another asset, liability, or stockholders' equity, okay? Take a look at this here now. Assets equals liability plus equity. We should know that now like the back of our hand. Look at the equity section though. The equity section consists of really 5 things when you think about it. Common stock is a separate line item, and retained earnings is a separate line item. The total of these two, common stock and retained earnings, equals equity. If we pay dividends, they reduce our equity by reducing retained earnings. Of course, profit will increase equity. So here's our revenue minus our expenses, and they would go right up into retained earnings, okay? And we went through a bunch of transactions like this, which I'm not going to do now. But remember, we opened up the company with 10,000, so cash went up and common stock went up. If anybody has any questions on any of these, jump in. I'm going to go through them real quick. We bought equipment for cash. Cash went up, equipment, notes payable went up. Here, we got an advance from somebody, so we got 5,000. And let me turn the page. Yeah, 1,200. And that goes into unearned revenue, which I'll talk about briefly. Here, we paid the rent. We paid, I'm going too fast. We received 10,000 in cash, okay? We paid the rent, so cash goes down, and the expense goes up. And notice they have a minus next to the expenses. That's because that reduces stockholders' equity. Here, we bought an insurance policy. Cash went down, insurance went up. We hired 4 new employees. Guess what? There is nothing to do with that. So what? We hired 4 new employees. Paid a $500 dividend, huh? Here we go. A dividend removes cash and lowers stockholders' equity. And then they don't want us to get into the last one would have been an accrual for 4,000 in salaries and wages. Here you go, another look at our transaction analysis for the month. Now, the reason I went through that fast is because when you're in the world of accounting, you're not going to be talking increase, decrease, plus, minus, more or less. You're going to be saying debit, credit, which means you really have to know your debits and your credits. Excuse me. Whoa, that's good whiskey. Okay. Explain how debits and credits are used. What we're talking about is called the double entry system. Debits must equal credits. If the debits are higher than the credits, then the account has a debit balance. How did they ever figure out that the balance is 15,000? You add all of the transactions that are debits, you add all of the ones that are credits, and the high man wins. 18 is higher than 3 equals 15, okay? That shouldn't be a problem. And I guarantee you on the test, you'll be asked to do one of those and consider it a gift, okay? If credits are bigger, then it's a credit balance. Here we have $11,000 worth of credits against 10 of debits. Here are just different ways to try to memorize the debit credit. I cannot help you with this at all, other than to urge you to do your homework and try to get into your mind what the normal balances are, okay? The normal balances. The Chicago Cubs, all right. Take a peek at this grid here. This might be one of the better ones. I think there was another one I liked. Okay. Well, the point is you've got this grid here, which shows you that an asset goes up with a debit. So do expenses and dividends, okay? I'm going to read you a mnemonic. You don't have to write this down if you don't like them, okay? After eating dinner, let's read comics. After eating dinner. After assets, eating, expense, dinner, dividends. Those are your debits. Let's read, and capital is the other word I was looking for. Oh, I'm sorry, guys. I thought I turned this thing off. Okay. So you study the debits and credits as best you can. I think I told my bad joke that I tell every semester about a guy who worked in accounting for 50 years. He worked for 50 years in accounting, and he came to work every morning, opened up his desk and pulled out a little piece of paper that he had locked up. And he would hold the paper up and he would nod and look at it for a moment. When he retired, everybody was curious to see what he had written on that piece of paper. So they opened up his desk and looked at it. You know what it said? Debits on the left, credits on the right. So my point is you shouldn't take 50 years to know your debits and credits, okay? Debit and credit rules. Debits, well, they're looking for an answer here. Debits increase assets and decrease liabilities. Accounts that have normal debit balance. Well, that's the after eating dinner stuff, right? That would be D, after eating dinner. Okay, now we're going to go through a 2-chapter journey along the way with these arrows, okay? We're going to learn how to journalize a transaction. That's what we're up to now, the blue. Journal entry. Journal entry. This is the act of recording a transaction, which will then be posted to a general journal, posted to a general ledger. Okay, the general journal, what they're calling journalizing. They're giving you three here. Sierra issued stock for 10,000. They borrowed money and they bought equipment. So look at your journal entry. The top of the page, you put the year. You only put the year down one time. That's it. The year just goes on the top. And then the next line, you have a debit to cash and a credit to common stock for 10,000. Note the indentation on common stock. All credits are indented like that. And that's important because when people come to look at your financial statements, they're going to expect to see the credits are indented. And if not, it shows a careless touch. Here, they borrowed money. Debit, cash, credit, notes payable. So these are your journals, your journal entries, okay? And now you've spent I don't want to say you spent, you spent some time at work and you had a little work to do and you wrote in all these journal entries. Then you went to lunch. Now you come back and now you look them over and you say, yeah, that one looks right. That looks right. These are good. Now you're ready to post them. Post them to the general ledger, okay? Post. So we started off with analyzing transactions, journalize, now we're gonna post. When you come back to those journal entries and you're looking at them all on your screen, if you're in QuickBooks or Mass 90 or Oracle, whatever system you're using, you're gonna hit the button called post. And when you hit that button, all your data goes into your general ledger forever. If it's wrong, it's wrong. You can't remove it. You can only correct it subsequently. So think of your general ledger as a bunch of folders. The general ledger, a folder of anything the company thinks is worth tracking. Like here, cash, supplies, land, interest payable. I don't see anything there that is unusual. So here we go. We now posted this entry. And when that posting was done, it traveled on these red arrows to your general ledger, okay? Note the debit to cash and the credit to common stock, okay? This is one of the folders in your general ledger. This is another of the folder. You have one for each thing in your chart of accounts. Posting transfers journal entries to the ledger, okay? An important term. A lot of times, not a lot of times, just in my experience, especially when I was younger, I might be writing some journal entries and somebody else might be writing them. And then we'd find out that one of the pieces of information I received was wrong. Thus, my journal entry is wrong. And you'd have people running around, Bob, did you post? Did you post, Bob? And I say, not yet. And they go, phew. So you want to get it right before you post. I got enough of them wrong without posted enough wrong ones without being distracted by bad information. Steps in the recording process. Okay, now I'm not going to go into this in any great detail. You've seen one, you've seen them all, okay? So let's take a peek here. Here, the stockholders invested $10,000 in our company. At the beginning of this chapter, we were doing everything increase, decrease, remember? We said cash went up and equity went up. Here is our journal entry. Journal, we're not doing this stuff anymore. We're doing journal entries. We debit cash and credit common stock. And then we hit the post button and we move the debit here, 10,000, the debit there. So these slides might be a good idea. Just kind of scan them quickly, you know, get a feel for it a little bit. Here, what's this one here? We sold our services. Apparently we're a guide service. We provide tours of Yosemite. People come to us and they paid us $10,000 for a couple of days showing them around the beautiful Yosemite National Park. We debit cash, we credit service revenue. Note your cash now. Your cash there showing you all of the transactions accumulating there, right? There's 10,000. There's 600 coming out of cash. Here they hired 4 employees. Nothing, we don't care about that. Cash went down another 500 here, right? With a credit. Keep going. Here are all your journal entries, huh? All your journal entries. Should we post them? I think we should. Bam, posted, and that's what we have. So take a look at your general ledger. These T accounts mimic your general ledger. In the real world, the T account is this piece of scrap paper to organize the data. And as you get further along, you'll learn the efficacy of them. But it also mimics what the general ledger looks like. So look at your general ledger account for cash. You had 0 to begin with. Well, and then we brought in so much here. That's 26.2 minus this number. Your balance is 15,200. Your supplies, etc., etc. Your revenues were 10,000, and then you had some expenses here, 4 and 9, maybe some more. Maybe, maybe not. Selected transactions. Post these to the T accounts. Well, I'm not going to do this with you, but where would you put this 30,000? It would go right there as a debit, right? Credit to common stock, accounts receivable, debit, service revenue, credit, cash, debit. So you have 2 cash accounts. They've got 34,000 now, and they've only got 2,000 left in AR after this guy paid 4,000 of the 6 he owed. Preparing a trial balance, okay? Super important. The trial balance is going to be our vehicle for preparing the financial statements, okay? It's really just a piece of scrap paper. Nobody in the history of finance has ever said, hey, Bob, I saw your income statement, everything looks good, but I want to see your trial balance. Nobody wants to see a trial balance. All it really does is provide you a worksheet to prepare the financial statements, and also it proves your debits equal credits. And that used to be a problem in the old days when we had to do this in pencil, believe it or not. That's not going to happen to you guys with computer systems. So now we're preparing a trial balance. What is a trial balance? What is it? It's a list of all the folders in your general ledger, all the accounts. And you're going to have one column for the debits and one column for the credits. And that's what you see here. Debits equal credits. There's our trial balance. They go in order too, don't forget. They go in order of assets, liabilities, equity, revenues, and expenses, okay? And the trial balance may balance and still be 100% wrong. Prepare a trial balance. Now on the test, you might get something like this, only a little simpler with less lines, but it is what it is. Prepare a trial balance in good form. Well, we know the trial balance begins with the assets, right? And they got to be in order of liquidity. Liquidity, meaning how fast you can turn it into cash. Cash and accounts receivable are super liquid. Cash is 100% liquid. So we know we're going to start with cash, probably accounts receivable, cash, accounts receivable. I see prepaid insurance and equipment, long-term. So take a look at it. We picked up those 4 assets. What are our payables? The payables are easy to check out because guess what? They have the word payable in them. So I see accounts payable, notes payable, and salaries payable. Notes payable, accounts payable, salaries payable, and we bring over the remaining items. There is the trial balance for Snowgo Corporation. That takes us through chapter 3. You ready for chapter 4, John?
Yes, on the trial balance, if there had been unearned revenue, does it always go after payables?
Unearned revenue is a liability. Yes, it's part of your liabilities.
Okay,
Unearned revenue is money you receive in advance before doing anything. In other words, if you work for the Dodgers, I work for the Dodgers, I'll say, I work for the Dodgers. You send me season ticket money in January, right? But nobody plays baseball until April. So when I get that money, I can't call it income yet because I haven't earned it yet. It's called unearned revenue. You debit cash, credit the liability. And that liability, John, is not in money, but it's in 81 games of baseball.
okay,
Okay.
and then within liabilities, is it put below payables or above payables?
I go below payables.
Okay,
Yeah, that's a good question. Typically, you're going to start your payables with accounts payable, then notes payable. They're reversed here, but that's not a big deal. Okay.
okay.
All right, we'll go into chapter 4. Let me get rid of this. Chapter 4. Let me get rid of chapter 4. Okay. Oh boy, excuse me. I work a whopping 8 hours a week and I'm exhausted. Okay. Modules. And let me dig up Mr. PowerPoint here. Okay, now chapter 4 is where we complete the accounting cycle. Come on, come on. Here, let me share this. Chapter 4, do you see it, John?
Yep,
All right, if John sees it, everybody sees it. Okay. All right. Okay, now we're going to talk about accruals. Everything we do in accounting is called accrual accounting, not cash basis. Accrual. And I can't say this enough. Accrual accounting means that revenues are recorded at the moment the transaction takes place. The minute that truck left your store, you then are enabled, then can call it a sale, okay? Before that, it was nothing. You make the same rules for expenses. You record an expense when it's occurred, when it's been incurred or occurred. For example, your electric bill. The month comes to the 31st and you don't have the electric bill yet. Well, you can't wait 3 weeks to get the electric bill. You have to record something. And that's called an accrual of an expense. So let's take our way through this. Periodicity. They like to throw some of these terms on the test. Periodicity, which I think is the correct pronunciation, is just the accounting principle that a business can be broken up in little bite-sized pieces, like a month or a year or a quarter for analysis. The revenue recognition principle, we just talked about this. Revenue is recorded when you perform the service or move the merchandise, okay? I would skip this slide here. This thing is a bunch of baloney. The expense recognition principle. Let the expenses follow the revenues. You record expenses when they take place, not when they're paid. And get familiar with these terms because these things pop up on a test but automatically. If we were in the classroom, my test would have maybe 40 multiple choice questions, which would include a couple of these and maybe 3 or 4 problems. I keep you really busy. Here, we're limited to multiple choice or true false questions. So you have to have some of these types of things in your mind. Accrual based. We're not going to talk about cash basis at all. There's no such thing as cash basis accounting as far as the world of real accounting is concerned. If you hear somebody say they run their business on a cash basis, they're going to cash basis themselves out of business, unless they're really have super cash flow and profits and they don't worry about good financials. Now we're going to talk about adjusting journal entries. Adjusting journal entries. These are needed at month end because there are certain things that have taken place that we cannot record until month end. And these are called adjusting journal entries, okay? And they are to make sure that everything is correct, your balance sheet, income statement. Let's go through the deferreds first. You see where it says deferral? Prepaid expense. On December 31st, your company bought a $12,000 insurance policy, casualty insurance. When you bought that insurance policy on December 31st, you had no insurance coverage. You don't have any insurance coverage until when? January 1st of the next year. So when you buy that policy, you will debit prepaid expenses and you will credit cash or AP, whatever, okay? And then during the year, you're going to take 1/12 of that $1,000 and prepare the adjusting journal entry, which we'll get to in a second. You see below it, unearned revenue. We just talked about that. It's cash received before services are performed. Now, let me give you a little tip. Prepaid expenses, unearned revenue are the same thing. Hey, John, you want to come back online, chat with me for a second?
Sure.
Yeah, you asked about unearned revenues. Prepaid expenses is the same exact transaction, except the prepaid expense, I'm receiving your money and I'm debiting cash and I'm crediting unearned ticket revenue, right? Something like that. You bought the policy, so you're debiting prepaid insurance and crediting cash. Do you see, John, how the two transactions are the exact same thing?
So on mine, the prepaid insurance would show as a asset. And on the insurance company, the unearned revenue would be
That's right.
would
And
be
I'm going to
insurance
be
policy.
recognized. I'm sorry, go ahead, John.
Yeah, and so the unearned revenue would be the liability on the insurance side.
Yeah, you got it. And during the year, you're going to be recognizing revenue and I'm going to be recognizing expense.
Got it.
Okay, thank you. And then we have accruals. Accruals. Let me go back to deferrals. Deferrals, just briefly. Think of deferrals this way. Money changed hands, but nobody did anything. Deferrals. Money changed hands, but nobody did anything. Okay? Accruals, there's no money, but something happened that we need to record. Accrued revenue. Maybe you loaned money to me. You stupidly loaned me $100,000, which I'm supposed to pay back in, say, 5 years. But the annual interest is $10,000. At the end of the year, if I haven't paid that, because I'm not going to pay it until January probably, at the end of the year, you have to record that interest income. You're going to debit interest receivable, credit interest income. Most of your accruals, though, are going to be for expenses, salaries and wage expense, debit, electric bill, debit, whatever you have to accrue. These are expenses that are incurred, but not yet paid in cash. Revenue, services performed, but not yet received in cash or recorded, okay? So here's the trial balance. This is the one we were just looking at. We were just looking at this guy. I could worry there. So now they're going to talk about the deferrals we talked about, okay? Prepaid expenses. We make a cash payment before we can record any expense. And you can have a lot of them: prepaid insurance, prepaid supplies, prepaid taxes. Prepaid advertising, that's a classic. And take a look at your whatchamacallit, general ledger here, your T accounts. We purchased this asset, and then we're going to credit it out eventually over time as an expense. Supplies. We bought supplies for $2,500. At the end of the year, there was only 1,000 left. That tells us that we used 1,500. If we used it, we expense it. We debit supplies expense and we credit supplies. Insurance policy. Insurance policy. They paid $600 for 1-year fire policy. Well, they did this on October 4th. Coverage begins on October 1st. So we record the payment by debiting prepaid insurance and crediting cash. And now at the end of October, it's time to record this adjusting journal entry. We debit insurance expense and we credit prepaid insurance, okay? Let's talk about depreciation. I think you're seeing this for the first time. Depreciation. This is an attempt to allocate expenses. It has nothing to do with the value of the asset. Assume depreciation on the equipment is $480 a year or $40 a month. You debit depreciation expense and you credit accumulated depreciation. And this is the entry. I tell students, you pray it will be on the test. You want this one on the test because it's always a debit to depreciation and a credit to accumulated depreciation. Accumulated depreciation is a contra asset account. I think that's the first contra asset you're seeing. It means that it's an asset, but it's an oddball in that it goes up with a credit, okay? All contra accounts are married to the general account, to the boss, and accumulated depreciation is married to the equipment account, okay? The two of them netted out becomes your net book value. So notice what they do here. They debit depreciation expense and they credit accumulated depreciation. Keep these words in mind. You never credit the equipment. You never credit the original cost of the equipment. Never. What you do credit is the accumulated depreciation, okay? You see that $5,000 equipment? That's going to stay there forever. But November, we're going to see another 40, another 40, another 40 here. Depreciation. Book value is the difference between the original cost and the accumulated depreciation. And what you see here, you see where it says equipment minus that 40 equals net book value. That's precisely how it's going to appear on your financial statements, okay? Prepaid expenses. Unearned revenue. Oh, we did a lot with unearned revenue today, huh? It results in a liability account when you receive the money, and then when you perform the task, then you record the revenue. Another example is a lawyer. You hire a lawyer to maybe prepare a will or a living trust, and the lawyer said, well, that's going to cost you $5,000 with $1,000 down right now. Well, when you give him that $1,000 across the desk, he is going to debit cash and credit unearned revenue. Then when he goes out and does something, then he can claim revenue. Advertising. Okay, I'm not going to go through these in any real detail other than tell you this is a good series of slides here. Insurance expires at the rate of $100. When they use the word expires, they mean expense for that period. Expired, it died. Salaries on hand are $800. You had $2,800 to begin with, so your expense is $2,000. Okay, depreciation, you know that's a debit to depreciation expense and a credit to accumulated. And during March, we had some unearned revenue reported. Let's take a look at that one at least. Look at the unearned revenue. We did $4,000 worth of service. So we can relieve the liability by 4,000 and credit service revenue, okay? Let's look at accruals. Accruals. We're gonna have to accrue things like interest, rents, maybe any expense that might pop up, okay? Accruals. Accruals. One thing as a general rule, not a general rule, more specific than that, a 100% rule with adjusting journal entries is there's no cash involved. So if you're trying to glean an adjusting journal entry, don't put the word cash down if you're just guessing. You can guess better than that, but there's no cash involved. So here we did, okay, this one I'm going to skip because that's a simple one. Here we go. Accruals. Expenses are recorded before the cash payment. Expenses are recorded before the cash payment. We're not going to wait for the rent bill. We're not going to wait for the tax bill. We're going to accrue something. And with an accrual, we're going to debit an expense and credit a liability, which should be called accrued payables or accrued accounts payable, okay? Let me take you through a note, just to go over how we calculate the interest. Sierra Corp signed a 3-month note, huh? So they loaned $5,000 to me, huh? I borrowed $5,000. The note I have to pay is 12%, but I don't have to pay it for 3 months yet, right? So at the end of the year, my payment's probably going to come January 15th. At the end of the year, we have to compute the interest for 3 months. Whenever you see an interest rate on a borrowing situation, it means 12% per what? Per year. So 12% of $5,000 is $600. How long a period are we accruing? October, November, December. Well, 1 month is $50, and that's what we're going to accrue for the month of October. At the end of November, we're going to accrue another 50, etc. So don't put $600 down as the amount. You would be putting the yearly amount there. Here's one I know you guys should be a little bit familiar with. We're all working people, huh? None of us were born into luxury, except me, maybe. No. Okay. Look at the calendar here. It's called a payroll calendar. Notice that the payroll period begins on the 15th and ends on the 26th in October. So what they're telling you is that this company pays its employees every 2 weeks. And on the 26th, they did get everybody paid. They paid that by the end of the month, okay? But look what happened on the last 3 days of the month. On the 29th, 30th, and 31st, you worked those days, right? You worked those days. And you made $2,000 according to what it says above. Well, the company is not going to pay you this money until the 9th. They're not even going to record it probably until the 5th or something, that Monday. But you work those hours in the current month, therefore it's a current month expense. So please take a look at this journal entry. You're going to debit $1,200. The accrual amount is $1,200, debit that, and credit salaries and wages payable. It really should say accrued salaries payable, okay? The hours you work in the current month need to be accrued, and it's going to be done with the debit to the expense and credit to the payable. Not gonna worry about that. Okay, let's look at a couple more entries. We'll get out of here. The company owed its employees $800 that they're going to pay in September. Well, you worked in August. That's where the money belongs in August. We're going to debit supply salaries expense $800, credit accrued salaries payable. Okay. They borrowed 30,000 from a local bank for 15 years. The rate is 10%. What's 10% of 30,000? That's $3,000 a year or $250 a month. That's not an accrual. Okay. So now what have we done? We learned how to prepare a trial balance. We learned how to journalize and post. We learned about adjusting journal entries. Now we're ready to prepare the financial statements. And this is the part you should be pretty good at. Now here is notice the word they're using here, adjusted trial balance. This trial balance is blessed. Everybody signed off on it. This is our book of records here that we're going to bring over. Our first financial statement to prepare is the income statement. Please look for the first revenue line. You see that revenue line, everybody? Draw a horizontal line between service revenue and dividends. Draw a horizontal line. The reason I tell you that is because everything below that horizontal line goes on your income statement, and everything above goes on the balance sheet. Okay? That'll make life easier for you. We should never, never, never give you a trial balance that's out of sequence, it's out of order, and make you pick and choose. That would be a dirty trick. Adjusted trial balance review. Preparing the financial statements, income statement. So take a peek here. Look at your income statement. It starts right below the Bob Smagula horizontal line. Service revenue, all the reds coming over here. There's your income, 2860. That looks familiar, doesn't it? Here's your retained earnings statement. We had 0 to begin with. Now we have income of 2860 and dividends, which you pull right from here, 500. New balance, 2360. And now the balance sheet is probably the easiest one, because all you're going to do is copy everything except one number. What's the one number on the balance sheet that just changed? The retained earnings. It's not 0 anymore. It's 2360. 2360. And there we are. We're in balance. There's your 2360. Okay. Skolnick was organized. I'm just going to look at this real quick. See, here they're doing us dirty. They're giving us, oh, this is a trial balance. I'm sorry. I thought this was just a random bunch of stuff. Oh, yeah, this thing is all out of order. And I don't like working with these. And I find them more, what's the word I want? Misleading as far as the students go. So the financial statements. You should be able to put financial statements together now, huh? Now we're going to go into our last part here. And students sometimes get a little confused on what are called closing entries. Closing entries. You ever hear the expression, we're going to close the books? Close, close, close. We're going to close the general ledger or certain parts of it. We have 2 types of accounts, temporary, permanent. Temporary is income statement. Can you remember that? Make a note. Temporary accounts are income statement stuff. Permanent is balance sheet. We don't close the permanents. We only close the temporaries, which are your income statement or the revenues and expenses, okay? And we'll close the dividends too. So let's take a look at this. This is not that hard if you understand what we're trying to do. Do you remember our profit of 2860? Remember our profit of 2860? We have to get that 2860 into retained earnings. We haven't written a journal entry for it yet, have we? No, that's what we're going to do with the closing. The closing entries are the mechanism for getting the retained earnings balance into your balance sheet, get it into the ledger. Closing entries. It's as simple as what you see here. You're going to close the revenues into an account called income summary and close expense accounts. What do I mean by closing? I mean, turn the balance to zero. When the next month begins, we don't want to see expenses sitting there. Those expenses have nothing to do with that current month. So we have to zero them out and move them over to retained earnings. It's done at month end. I mean, if you really want to be anal, you could do it every day. Every time you sell something, you could close it out, but that would be a ridiculous waste of resources. So revenues have a normal credit balance. Would you agree? Yep, that's right. Revenues have a normal credit balance. To zero it out, we're going to debit service revenue. Now the balance is zero, which is what we want. Income summary now has 10,600. So now the sales amount is sitting in the income summary. Look what we do with the debit balances of all the expenses. We credit each and every one of them. Credit, get them down to zero, add them up, and that's your debit to income summary. The difference between these two numbers, 10,600 minus 7740, guess what? Is 2860. You remember our profit for that amount? We now have the profit sitting in income summary. So it's just a matter of clearing the income summary. The income summary has a credit balance, which represents our net income for the period. We're going to debit income summary. Credit retained earnings. There we go. We finally put something into retained earnings. And dividends normally are closed into retained earnings. Although I've seen balance sheets where they leave the dividends on there as a separate line, but we don't want to do that here. So we're going to close that. We're going to reduce retained earnings for the amount of the dividends and credit dividends. And they're just showing you the posting of the entries. Here's our income summary. This is a clearing account. You're never going to see income summary on the financial statements. It's always going to be a zero balance. Just for this brief moment of closing. Here's your service revenue. They were 10.6. We debit it. Now the balance is zero. And we move it to here. All of your expenses, 1,500, 0, 0. All these are now zero, huh? And we move all of them over to here. When we add them up, we'll get 7740. And that leaves a balance of 2860. So we're going to debit income summary, credit here, and then just close the dividends, okay? Closing entries. Why do we do closing entries? To zero out the temporary accounts and move their impact, meaning the net income, into retained earnings, okay? So this is what we're supposed to have learned over the last two chapters, the accounting cycle. You analyze something, you journalize it, you post to the ledger, you prepare a trial balance, which you know is wrong. So you have to post adjusting entries which never have cash, hint, hint. You prepare an adjusted trial balance. Now you can prepare the financials. Now you can close. And then we'll ask you to prepare what's called a post-closing trial balance, which will have no temporary accounts in it. The post-closing trial balance will have no temporary accounts in it. And they're just showing you that here's a different situation. They're closing the revenues with a debit, crediting income summary. They had three expenses that totaled $80,000. Credit the expense to zero amount. So our profit, it looks like our profit is $18,000 in profit. We take that over here and we want to get rid of the dividends, okay? And we are done with our review. Anybody got any questions? What do you think, Josh? Would it help you out?
Yeah, it was a really good review. I had read most of the chapters, but going through this made it a lot more clear for me.
Okay. Yeah, I mean, I wish we were in the, part of me wishes I was in the classroom, where I think you get a little better feel for it. But on the other hand, it's nice to wake up, and just walk over to your computer and join
Yeah.
school. Thanks for dropping in, Joshua.
No, thank you.
I'll skip Gigi. John, any questions?
None. I'm good.
Okay. How about you, Hope? You were nice and quiet there. What's up with you?
Nothing much. Just listening
think-
on the lecture.
How are you gonna do on the test? Real good?
Uh, maybe I might. We'll see.
You will. Hey, Gigi, you're good?
Yes, and that was very helpful. Thank you.
Can we see your face, Gigi? You have an
And
important,
see me?
what's the important duty you have right now at the end of each class?
What's important do?
What do you have to do at the end of the class? This is your assignment. You're supposed to say, I move, the meeting is
Oh,
over.
yes. I motion to adjourn this meeting.
Okay, we'll see you guys another time, okay? Bye-bye.
Thank you.
Yes, yes. Stay safe, everybody. Good luck on the midterm.
Thank you too.
Bye-bye.